Well, we had a few panels out there, and generally, the asset class that has really outperformed inflation in terms of like not just covering inflation, but growing at a rate higher than inflation over the long term, if you can hold it, is U.S. equities. And the reason for that is very simple. If you think about inflation, it's an economic shock, right? For businesses, it means higher prices, higher costs, right? But for businesses to survive, they have to offset those higher costs with higher prices. Otherwise, they wouldn't be in business. Systematically, U.S. equities is basically is profits. It's basically your revenues minus your expenses. And if they're not moving in tandem with each other, then you're not a viable business. But in the aggregate, U.S. businesses do a remarkable job in managing through inflation by pushing on prices to their consumers. And I don't see this specifically in every business in every point in time, but in the aggregate, on average. And the data bears that out because, inflation has eroded the wealth of people who just sit in cash, right? Because ultimately you're earning very minimal rates of interest, but your purchasing power is being eroded because prices are going higher. But if you hold a stock portfolio over time, the stock returns are a multiple of the price elevation that you experience from inflation. So, in general, I would basically recommend for people who have the wherewithal, in terms of a time horizon, to be heavily invested in equities or equity-like instruments to cover inflation. But for people who generally don't have that much of a time horizon, so if you're thinking about somebody who's 55 and above and who are close to retirement, they can't absorb the volatility of equity market risk to the extent that somebody who's much younger can, right? Because their earnings horizon is limited by their age. So for those sort of people, we think that you still should have a sizable allocation to U.S. equities, but obviously much lower than what would be for somebody who's at a younger demographic or a younger cohort. And what do you replace the bond allocation with in an asset allocation sense? Or not necessarily replace one for one, but if you want to underweight bonds for precisely the reason I mentioned, with fixed interest at a time when prices are rising and your purchasing power is going to be eroded from that effect, we're sort of advocating investments in things like real estate partnerships, perhaps other parts of the credit markets that are not that exposed to inflation. Some of them may structurally have floating rate coupons where the interest that you get from those instruments rise as inflation and interest rates rise. Some of these instruments also are not the most liquid, but we'd say that not everybody requires liquidity of principal every day. The bigger objective is basically earning the income that covers inflation. So we're advocating some of those sort of re-engineering of overall portfolios, but ultimately we just absolutely think that the best hedge against inflation, so to speak, if you can hold it, is U.S. equities, because there's a one-to-one correlation between profits rising and prices rising at the same time.